In this week's video, we'll review the latest charts to help us answer the question, are we looking at a false bullish move or a sustainable rally in stocks? Respecting that there's a lot of information on our screens here, we'll walk through this slowly. It's all easy to understand. Chart on the right side of the screen is SCHG as in George relative to SPY. It's growth stocks relative to the S&P 500. This is Q1 of 2020 here where my cursor is. Growth stocks significantly outperformed the S&P 500 from roughly January of 2020 all the way into the U.S. election in Q4 of 2020. Then you can see here growth stocks started to underperform the S&P 500 fairly significantly after the U.S. election. Really didn't see any improvement. This is the look of the chart as of early June of this year. So this is growth stocks, very similar situation with the triple Qs or the NASDAQ 100, and we can make a very similar argument with tech ETFs as well. The difference is this peak comes in November of last year, and most tech had their final relative peak in Q1 of 2021. It was fairly obvious from price here to see momentum is waning. We can see that in RSI here on the bottom of the screen, and we can see it here with CCI. And this is the look of all of this in early June of this year. Similar situation here. If we look at FDN or internet stocks in isolation, they did very well, and then in isolation started to lag here in Q1 of 2020. You can see we have a series of lower highs when we look at FDN in isolation. We have the same thing here in the relative strength index or RSI on the bottom of the screen. So one possible theory with the markets is your leaders are peaking first. Your leaders are peaking first. And it's possible that eventually this weakness will spill over into the entire market or the S&P 500. Similar thoughts here. A previous leader, internet stocks, start to lag. The S&P 500 is making higher highs here in 2021, not so for FDN. And this is a chart of the S&P 500 that we covered on June 11th, and we covered it again on June 18th. On June 11th, you could see the S&P 500 made a discernible higher high, but we had a relatively serious momentum divergence. And at the time, that seemed to align with the theory that it was possible that this was the early look for an entire market that could be getting ready to roll over. After this divergence on June 11th and the subsequent week, we covered the same chart and noted that the S&P 500 dropped 81 points between June 14th and June 18th. Once again, somewhat aligning with the hypothesis that this weakness here was the early stages of a possible topping process in the S&P 500. So the S&P 500 makes a new closing high here in early to mid-June, and then the subsequent week falls 81 points. The week of June 14th to June 18th also featured a lot of damage that we covered in last week's video, including this chart here. This is a relative breakdown. This is small caps, a previous leader, relative to defensive treasuries. You can see the high in the ratio. The highest high was made in March of this year, and then small caps started to underperform defensive TLT. As of the close on Friday, June 18th, you can see we have a clear bearish breakdown here, below these lows here, and if we drew a trend line from the low, we broke below it as of the close on the 18th. And for clients, this will give you some idea why we reduced our exposure to small caps in this area here. So as noted, this is a relative breakdown here. And we also had isolation breakdowns that we covered last week. This is XLI, similar situation here. Draw a trend line from the low, March of 2020. Make sure we capture all price And we go in this case to the highest high here on a high-low close chart. As of the 18th, we had broken that trend line, and then we had made a significant lower low relative to this consolidation period here. This is a clear bearish breakdown, a breakdown that we covered in last week's video. Very, very difficult to make the argument that this is a good-looking chart a week ago on June 18th, and thus, on the summary slide from a week ago, based on everything that we've just covered, including growth stocks and tech stocks peaking on a relative basis and getting weak and having a fairly sustained pullback earlier this year, a week ago, based on these breakdowns and everything that we saw, increasing odds of a more sustained pullback or correction in the S&P 500. We had a wide range of risk-on, risk-off charts that had shown observable deterioration. We also noted that it was extremely important to maintain maximum flexibility. How do you do that? You do that by acknowledging not only the bad or the concerning data, but also the positive data. So in last week's video in the close, we noted that all trends have counter-trend moves, which basically means in that case, when you're in an uptrend, you can go backwards, and when you're in a downtrend, you can go forwards. That doesn't necessarily mean that the trend is ended. And while we had observable breakdowns, we noted the damage to the broader market, mainly the S&P 500, was still somewhat muted. In the longer-term outlook, we really didn't have any negatives on the longer-term charts as of last week. Thus, all of this a week ago on the 18th made it fairly easy to say we really don't know what the next week is going to look like or what Monday morning is going to look like. And that came in handy because before the market even opened on Monday, June 21st, this is a tweet from 9:02 a.m. Eastern Time, we really didn't get any follow-through. S&P 500 futures green before the open. NASDAQ futures green. Small cap green. Mid cap green. And it's not uncommon when you have a breakdown like the one that we had as of the close on Friday, June 18th, that things can get very, very ugly very, very quickly. Here's one example. We break below this low here. Really, really ugly. Another concern that we had on Friday, June 18th was just simply good money management. You can see here, if you have entry points anywhere in this area here, they're starting to get upside down as of Friday, June 18th. So we have trend concerns and cost basis concerns. So it wouldn't have been shocking on Monday morning if we saw something like this. For the most part, we saw the polar opposite, and there's information in these futures here. No follow-through. Really not what we would have expected after seeing something like this. Thus, from a binary perspective, the futures on Monday morning at 9:02 a.m., they really contradicted this bullet point from the previous Friday and this bullet point from the previous Friday. Thus, this is one little piece of the weight of the evidence, but it told us to keep an open mind about better than expected outcomes following this breakdown on Friday, June 18th. And if a chart is helpful in terms of telling us to be concerned, it should also be helpful when improvement occurs. Thus, after the market dropped 81 points, we covered this chart on June 11th and again on June 18th, where we said there was momentum that was a little bit concerning. Did we see improvement here? The answer is yes. Covered in this tweet right here on the left side of the screen where my cursor is, downward sloping trend line, RSI poked out here and then made a higher high here. Now, instead of having a negative divergence with a downward sloping momentum look when price, the bias was up, in the short term here, price here is lower than it was here. RSI slightly higher, telling us on the 22nd at 3:09 p.m. Eastern Time to keep an open mind about this breakout potentially holding. And it's also possible that this weak momentum profile could be changing. Not a prediction, We're just acknowledging that this looks better here, really, than all of this in the rearview mirror. Also noted earlier in the week, Monday's close was in this general area here. On Tuesday, we wanted to see if we could break out above these levels, and we did get that. We got improvement here, and we got improvement here. How about this chart? This is the look here. You can see where my cursor is. We've erased what price looks like in June. So this is the look of the chart around June 4th, the look of RSI around June 4th, and the look of CCI around June 4th. We did indeed get observable evidence that looked better. This looks better than all of this in here. Notice price, or the ratio in this case, is making a lower high here relative to this and this. RSI down here, this is a higher high relative to this high here where my cursor is, this high here, and this high here. Also very, very noteworthy, CCI here at its highest level. We have to go all the way back to Q1 of 2020. And look what happened in Q1 of 2020 for the ratio. Not a prediction, but this looks different than anything that we've seen in this period here, where we had somewhat of a concerning slowdown in momentum. Doesn't predict anything, just helps us with odds. And this improvement here is now telling us that we should be open to the possibility that growth stocks might start to perform better relative to the market. Instead of having a downward slope like this, and this tell us it's possible that we could get a breakout in this direction. Contrast this improving look here and this higher high relative to this high here with the relative look, KRE, regional banks relative to the S&P 500. This is the same day. Both of these charts are June 22nd. This is improving relative strength. This is a little bit concerning here, helping us understand, much like small caps, why our allocation to KRE, or why we had some profit taking between point A and point B. This is a break of a trend line here. This is a lower high relative to this high. When we come up here, this looks like support here has held. But now this looks like step 3, break of a trend line, a lower high, and then a lower low as of the close on June 18th. Doesn't necessarily mean KRE is a dog. It's just saying the probability that it's going to lead is lower with this look relative to the look in here. We saw improvement on the chart of the S&P 500. We saw improvement on this chart here. How about the FDN chart that we covered earlier? This chart's dated June 4th. FDN in isolation also improved. Price here, this is a new high relative to this closing high. And you can see RSI was stuck here, and then it exceeded this high here. This chart on the right is June 24th. This look here really doesn't align with the theory that this is the early stages of a topping process in the S&P 500. Present day chart looks a lot better than it did on June 4th. Similar situation here. If the S&P 500, NASDAQ, and or the Dow are all going to rip higher, it's not really a big ask to want to see FDN relative to TLT adopt a better look than what we have here. This is a break of a long-term trend line. This is a low. If, walking forward from June 4th, this ratio breaks this line here, that would be step 3. So this is really consolidation here, maybe with some bias to the downside on June 4th. Once again, we were looking for some observable improvement. As of the close on the 24th, we have it. This look here looks a lot better than this look in here, and thus far, we've avoided this step 3. Similar situation here, FTech, which is information technology. This is very, very similar to VGT, high correlation to XLK as well. 7 weeks of consolidation in here. Here's gap land of confusion for a long time. It looks like, as of the close on June 24th, that we're trying to see some resolution here to the upside. But there's nothing definitive here either. But this right here, and this here, and clearing this gap, this gap, this gap, and basically holding above this gap, all looks better than what we had in this area here. And you may remember last week, one of the bullet points was the damage to the broad markets was still somewhat muted. And we showed this chart last week, dated June 18th, where we said this is still in an uptrend. This is somewhat of a step one look here for the probability of a trend change. If we look at the same chart on June 24th, it's also improved. Now we have a higher high here relative to these highs here. This is high-low close bars. This is the look of the closing chart, closing prices only, last Friday. So what it looked like last Friday was some consolidation, a bullish breakout, and then a failed breakout. So a failed breakout in the S&P 500 coupled with this momentum divergence that had not yet been cleared, and numerous charts in isolation that were either showing a clear step 3. How is this a step 3? Here's a break of a trend line here. Simultaneously, we have a lower high relative to this high here. This is high-low close bars we're using. And then this is a discernible lower low relative to this low. At a minimum, this is saying from a probability perspective that the odds have increased that this trend is rolling over relative to the look in here. And once again, based on this consolidation, entry points in this area here are running into problems in terms of money management rules and prudently protecting your capital. We also had the relative breakdowns as of June 18th. Weakening momentum looks in former leaders. We still, at that point, have these rollover looks on a relative basis in growth and tech and the triple Qs. That's all concerning. But as we've shown, much of that was erased over the next 4 trading sessions. This doesn't look like a failed breakout anymore because this is what happened in the next 4 trading days. A sharp reversal in a bullish manner, and we printed a new closing high. That negates this concern here. Can't call this a failed bullish breakout anymore. Something else that's noteworthy. Covered this breadth data a week ago on June 18th. Very, very lopsided in a bearish manner. History tells us that can be the look during the early stages of a decline. When you start to get something like this and it starts to happen 2 and 3 trading days in a row, so Friday the 18th, if this look spilled over into Monday, Tuesday, Wednesday, and Thursday, then we would expect a lot of our breadth charts to start to roll over. And as of the 18th, where my cursor is, we did make a lower low in NYSE stocks greater than their 200-day exponential moving average. Like many of the other charts we've shown you, it recovered quickly over the next 4 trading sessions. The breadth data that we had on the 18th, Friday the 18th, the lopsided negative data, told us the probability of a sharp decline in a lot of these breadth indicators was possible, or the odds had increased. Thus far, it hasn't happened. You may remember the blue line here, the blue line here, and the orange line here, and the orange line here are the levels that were exceeded on the downside when things started to get worse in the 2010 correction case, in the 2004 case. They're similar because there's a lot of similarities between the low in 2009 and the low in 2020 and the low in 2002 and 2003 and the low in 2020. But as of the close on June 24th, Thursday, we really got just the opposite. We didn't plunge in this direction, which is what the data from Friday told us on the 18th we should be open to. Right now, we're above all these lines. We're above the blue line, above this blue line, above this orange line, and this orange line. Is it possible that we're going to get a plunge like this? Absolutely, positively, yes, but we don't have it. And the last 4 days really don't align with increasing probabilities that it's going to happen. A similar situation here. NASDAQ 100 breadth momentum oscillator. It actually turned back up on June 24th. You can see this is a positive number here where my cursor is. And recently in 2021, the recent low here, quite a bit higher than this low here earlier in 2021. And similar situation. We're well above all 4 of our benchmarks for the correction in 2004 and 2010 in the S&P 500. This is the type of plunging look here in the indicator, and this is the S&P 500, that would raise yellow and red flags. We just don't have it yet. Is there anything that we can look for walking forward to help us with probabilities that we're about to peak? Yes, here's one example. This is the peaking process here. This is February 19th of 2020. So this is the highest close here before the massive COVID plunge that occurred in Q1 of 2020. Notice there's a clear divergence here with price. Price is an upward sloping line here. RSI at that point clearly making a lower high relative to this point here. And at this point here, ADX, black ADX above green and red, is telling us that this trend is extended. And then we have a divergence here as we make the higher high. So looking at the same 2 indicators on roughly the same type of time frame, this is June 24th, RSI basically going sideways. And you can see here, ADX is sleepy down here. It's basically telling us that we're in a trendless situation here. And if this bullish breakout to a new high holds, we should be open to the market possibly starting a new trend. This look here, this sleepy trend look, is quite a bit different than this extended look here where black is clearly above both green and red. RSI, nothing to write home about. Not sure there's really any great bullish information here, but what we can look for is this. If RSI can exceed these levels here, and more importantly, eventually get back above 70, that would really tell us that the look here would be almost the polar opposite of this divergence here. So just something that we'll be looking for in the days and weeks ahead. The 6 charts on your screen were printed at approximately 3:30 p.m. Eastern Time on Friday, June 25th, and they help us answer this question. Was the move this week, and was the move during Friday's session, supported by the weight of the evidence? The answer is yes. You can pause your video player. Every one of these charts contains something positive that was not in place a week ago. The same is true for the 8 charts on your screen now. All of them checked some type of positive box from a weight of the evidence perspective this week. After an incredibly bullish week, it can be very, very easy to throw all caution to the wind and believe that risk management no longer has a place in the markets. This is a stark reminder that that is not true. 1973 bear market, hypothetically, from the peak, if you had $1 million, at the low, your $1 million would have been worth a hair over $500,000. Was this a one-time event? No. Similar situation. From the peak in the year 2000 to the trough, you would have lost even more. Your account would have dropped below $500,000. Historically, can it get worse? Yes, in the 2007 case, $1 million at the peak in October of 2007 would have been worth less than $500,000, less than $450,000 in March of 2009. Those are rare cases, they are, but they might not be as rare as you think. 1937, your $1 million from the peak hypothetically would have dropped roughly 60%, and been worth somewhere in the neighborhood of 400,000. And last but not least, the Dow Jones Industrial Average unbelievably lost almost 90% of its value from peak to trough in the 1929 situation. Your $1 million at the peak, hypothetically, would have been worth, the day of the low, about $110,000. Quick summary after the close on Friday, June 25th. The purpose of the tech and growth charts was to help us understand more about the market's health. It is not necessarily a commentary on asset allocation. Good to keep in mind, failed bullish breakouts can be followed by big bearish moves. And conversely, if you know your market history, you know that failed bearish breakdowns, very similar to what we've seen in the past 5 trading sessions, can be followed by big bullish moves. Unlike what we've seen in recent weeks and months, this week we saw broad signs of an increasing appetite for risk. How long will it last? That remains to be seen. As always, the comments that we make in these videos are based on the facts that we have in hand. Just like we had to reassess those facts when they changed on Monday morning, we have to be willing to do the same in the days, weeks, and months ahead. Is everything perfect in the markets? Absolutely, positively, no. That's never the case. But much of the concerning evidence that we had a week ago improved greatly over the past 5 trading sessions. Nothing really new relative to our game plan. We all know the only way any of this works is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.